Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're watching most closely in the markets today. We just had the fastest return to new all-time highs in the S&P 500 after a 15% decline. It only took 55 days, about 2.5 months, to get back to record levels. It's like nothing has changed over the past 5 months. After briefly raising cash toward the long-run average in April, institutional money managers have a low level of cash again compared to history. Their actions suggest they are not concerned about downside for stocks. And retail investors continue to buy the dip every chance they get. This trend started during the pandemic when trading became free on all of the big brokerage platforms. It has continued unabated ever since. Another sign of the speculative nature of today's stock market is the shift towards same-day expiration options for trading. A decade ago, it was only 3% of S&P 500 options that traded which expired on the same day. Today, it's more than half of S&P 500 options volume that expires on the same day. Some of this is hedging by portfolio managers against any large single-day moves in the market, but most of it is retail traders trying to predict the direction of the market over a span of just a few hours. It's about as speculative as it gets. A significant reason why investors have been trained to buy the dip and chase winners to the moon is that momentum has been the biggest driver of outperformance over the past 3 years. From 2015 to 2019, all the major factors tended to trade in a similar range of performance. But since 2022, outside of quality companies holding their own, it's been all about momentum that's carrying the outperformance. We do not think this trend will continue forever. There will be a mean reversion at some point. But we acknowledge it in our portfolios by letting our winning positions run and selling our losers quickly if a position is not working and we do not have the conviction to double the position size. The best way to have played the momentum trade the past 3 years has been exposure to AI winners. In each of the last 3 calendar years, the 50 or so stocks in the S&P 500 that are considered AI winners have driven more than half of the gains for the market index. This doesn't just apply to technology stocks either. Specific utilities and industrial stocks have been bid to levels we've never seen before. The top 10 winners in the industrial sector over the last 18 months have outperformed even the tech winners by almost 50 percentage points. The catch is these industrial AI winners are now priced at levels we have never seen in the 50-year history of the sector. We would be wary of chasing AI winners in these adjacent sectors at such extreme prices. Now that we are back to where we were at the start of the year, the so-called hopes and dreams factor has returned to record levels again. We have shown this chart in the past. It splits the S&P 500 valuation into 3 components: book value, then the value of the expected earnings per share over the next 3 years, and finally a hopes and dreams factor that encompasses all the value of these companies beyond the next 3 years. On average, the hopes and dreams component is about half of the total valuation, but today it's 2/3 of the market value, which has only been eclipsed at the tech bubble high in 2000, then at the end of 2021 before the bear market in 22, and in February this year. After 16 years of amazing stock returns, investors have become conditioned to expect 15% annual returns like it's a normal thing. But that only happened because of expansion in the price to earnings multiple. If you look just at the last 10 years for the S&P 500, the fundamental growth of the index, which is dividend yield plus growth in free cash flow, was only 9% per year. That's about the same as the 10% annual growth from these 2 factors over the past 40 years. All the remaining gains from the past 10 years came from multiple expansion. This is not repeatable. In addition, the mega cap winners of the past 15 years cannot be the big winners for the next 10 or 15 years. 38% of the S&P 500 now comes from the top 10 companies, or 2% of the constituents. And half of the index weight comes from just 23 companies. This is significantly more concentrated than the 2000 bubble high. And if you look at the top 10 companies in 2000, you will notice how few of them stayed on top for the next 10 or 20 years. The top 10 or 20 companies in the index today are outstanding businesses. We own 7 of those top 23, but they are only 14% of our total stock portfolio, not 50. We think the next 10 years are more about diversifying beyond these mega cap stocks that have won the last decade. We are going to find out about the impact of tariffs over the last 5 months of this year. What we find interesting is that investors panicked when the initial announcements in April increased the average tariff rate from below 5% to above 25%. Now, deals are being announced at lower tariff rates than those April announcements, but it's still a lot closer to that 25% rate than the 2% rate previously. No one seems to think it will have any impact on economic activity. We'll find out. What are we doing with our long-term growth stock portfolio in this environment? We're seeking to allocate into 4 specific areas. First is defensive sectors like healthcare, consumer staples, and utilities. Second is very high-quality cyclical companies with consistent cash flow. These stocks act more defensively than the average cyclical company in a sell-off. Third are businesses with exposure to secular growth trends in their spaces. They trade more volatile than the market, but we're willing to have that volatility because of the high growth potential. Finally, high-quality energy and materials companies that we think can outperform over the next 5 to 10 years if commodity prices drift higher. What you won't see on this list are cyclical businesses without secular growth and that have volatile share prices. We do not want to include those names in the portfolio unless we can buy them at very cheap prices. We hope that gives you a sense of what we're seeing in the market today. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the content we think is most valuable for studying the financial markets today. If you'd like to learn more, please subscribe to our Oxbow Advisors YouTube channel.